You retire with everything you were supposed to have: the savings, the house, the Social Security check. Then the IRS sends you a tax bill that's 40% bigger than your bracket said it would be. By the end of this video, you'll know exactly why the same $1,000 withdrawal gets taxed at 22% during your last working year, and at almost 41% the year after, and the one decision you can still make tonight that turns the rate back down. And the trigger has nothing to do with your tax bracket. It's a single number written into the tax code in 1983 that has never moved. Most people only meet it once, and once is enough. Here is the scenario. You are 73 years old. You worked your whole career. Your 401k sits at $1.4 million. Your Social Security check is $40,000 a year. The IRS has a rule from the early 80s that decides whether that check gets taxed. The rule says if your provisional income crosses a certain line, 85% of your Social Security becomes taxable. That line is $44,000 for a married couple. It has not moved since 1993, not for inflation, not for cost of living, not once. And the year you turn 73, your traditional 401k starts forcing you to cross it. Forget brackets for a minute. Here's how the math actually works. You are 64 in your last working year before retirement. You pull $1,000 out of a traditional 401k to fix the roof. Your federal tax bracket is 22%. The IRS takes $220. The other $780 is yours. You turn 65, you file for Social Security. $40,000 a year of benefits starts hitting your bank account. 2 years later, you fully retire at 67. 3 years after that, you turn 70. By 73, the IRS forces you to start taking required minimum distributions from that same 401k. Roughly $50,000 a year, whether you need the money or not. So at 73, you pull the same $1,000 you pulled at 64. Same account, same bracket, same dollar. This time, the IRS does not just tax that $1,000. The dollar drags 85 cents of your Social Security check behind it into the taxable column. So a $1,000 withdrawal now looks like $1,850 of new taxable income to the IRS. At a 22% bracket, that produces $407 in tax on a $1,000 withdrawal. That is a 40.7% effective tax rate. That isn't a higher bracket. It is the same bracket with a second bill quietly stacked behind it. Same person, same dollar, same account. The only thing that changed is that your Social Security got switched on. Financial planners call this the tax torpedo. The mechanism behind it has a name I am going to give you now: the 1983 line. The provisional income threshold that decides whether the torpedo fires. It was written in 1983. Inflation since 1983 has run more than 200%. The threshold itself has moved 0. Now, let's run 3 lives. Same person, same balance at 73, same $40,000 in Social Security. 3 different decisions made back at age 45. Life 1 is the worst case. Every dollar you ever saved went into a traditional 401k. By 73, your required withdrawal alone is $50,000 a year. Add Social Security and you sit at $90,000 of provisional income, well past the $44,000 line. 85% of your Social Security gets taxed. Every additional dollar you pull lands at that 40.7% marginal rate. The tax torpedo runs your whole retirement. Across a 25-year retirement, the extra tax bill is roughly $120,000 above what a normal 22% bracket would have suggested. That is a kitchen renovation, or a grandchild's college, gone to a rule that has been frozen in place for 40 years. Life 2 is the middle case. You found out at 60, you started moving traditional dollars into a Roth IRA, $40,000 a year for 10 years, paying tax at 24% on each conversion. At 73, your traditional balance is smaller. Your required withdrawal is smaller. Your provisional income still crosses the line, but not by as much. The torpedo still fires, just on fewer dollars. Net savings over the retirement is roughly $60,000. Life 3 is the best case. Someone told you the truth in your 40s. Half your retirement money went into a traditional 401k, and half went into a Roth. At 73, your required withdrawal is on a $700,000 base, not $1.4 million. Your Roth withdrawals do not count toward provisional income. You can pull what you need from each side and keep your taxable income just under the 1983 line. The torpedo never fires. Your effective rate stays around 14% all retirement long. You do not have to convert at 60. You do not have to scramble. You already paid. That is the same person across 3 different lives. The difference is not how much you saved. It is how the money was sorted before you turned 65. In July of 2025, Congress passed a bill called the One Big Beautiful Bill Act. It added a $6,000 deduction for filers 65 and older, $12,000 for joint couples. The headline said no tax on Social Security. That headline was misleading. The deduction lowers your taxable income, but it does not change the provisional income rules. The 1983 line is still where it was. The torpedo still fires. The deduction also phases out for couples earning more than $150,000, and it expires after 2028. It is not bad luck, it is the structure. The rule was not designed to catch the wealthy. It was designed in 1983, indexed to nothing, and the wealthy do not trip it because their planners root around it. The people who trip it are the ones with $800,000 to $2 million in tax-deferred accounts. The dentist, the small business owner, the engineer who maxed the 401k for 25 years and assumed the IRS was on their side. You are not behind. You did exactly what every advisor told you to do for 30 years. The instructions were just incomplete. 3 things to do tonight. First, open the app for whichever brokerage holds your 401k or your IRA. Look at the percentage split between traditional and Roth. If you do not have a Roth bucket at all, that is the first lever to pull. Second, if you are between 50 and 65, look at whether your plan offers a Roth 401k option for new contributions. Every dollar you route there from now on is a dollar that will not trip the 1983 line at 73. Third, write the number 44,000 on a sticky note and put it on your monitor. That is the line the torpedo fires above. Most people never see the number until it is too late to move around it. You just did, and you did it tonight. If you found this useful, hit like, subscribe, and turn on notifications for more simple explanations.